Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter. On this episode, I have an opportunity to interview Carol Lee Roberts, who is the president of the Institute for Divorce Financial Analysts, which is the issuing body for the Certified Divorce Financial Analyst designations. We are going to get granular on issues that financial advisors need to be aware of as their clients go through the divorce process. Carol Lee, thanks for coming on.
Oh, thanks for having me, Jay.
All right, let's start high level. What is the current state and statistics around divorce today?
Well, I think everybody in our listening audience has probably heard that 50% of all marriages end in divorce. The good news is that isn't true, probably never was true. It was based on the way they were calculating the divorce rate. But when you go into accurate calculations of the divorce rate throughout the U.S. is actually decreasing and is hovering around 35%, except for the baby boomer generation, or those people over 50 years old. The phenomenon known as gray divorce is occurring not only in the U.S., but in Canada and in Japan as well. And that is the one demographic where divorce rates are actually increasing and is currently over 40%. The reason for this explosion of gray divorce, or the reasons, are that this is the group of people that are likely on second marriages, because the baby boomers were the first group to really divorce in large numbers. And secondly, the whole longevity issue. It sounds really horrible to say, but in my parents' generation, if you were 60 years old and unhappily married, you could just wait your spouse out. Now, at 60 years old, if you're unhappily married, you're looking at another 30 years. So that is also feeding in to the increasing divorce rates.
Okay. All right, so there's a lot to unpack there. So first, the divorce rate is not 50% in this country, which to me has been a number that's been thrown around since I was a kid. You're saying it's 35% until we get into the baby boomer generation.
Correct.
Okay, so why do you think the 50% number is thrown around so much?
When they first started tracking divorce, what they would do is they would take in any given year the number of marriages in that year and compare it to the number of divorces in that year, which has to be statistically the least accurate way you could possibly calculate that. When they started paying attention to the number of divorces that, the number of people who were divorced, the number of divorces in a given year, and whether they were first, second, third divorces, and that type of thing, they came up with a new statistical method called the cohort method of determining divorce rates. And that's where the 35% figure comes from, and the over 40% for people over 50 years old.
Got it. Okay, and then so this phenomenon of the gray divorces now is really going to have an impact on financial advisors as they are advising their clients through the divorce process. And you've outlined 5 pitfalls that advisors need to be aware of, and let's walk through them. So the first one you outline is that a 50-50 split is not always equitable. What do you mean?
The idea that most people, if they were to just, at first blush, try and divide a household for a couple, they would try and make sure that, if the couple was worth $500,000, that each party got $250,000. That sounds eminently reasonable and like a great way of doing it. The problem is $250,000 of a real estate asset that is the marital home versus $250,000 of a retirement account that is now kicking off tax-free or income or is growing tax-free are not equal in any way, shape, or form. So the real genesis of the CDFA designation was looking at the property settlement that is being recommended and rolling out the cash flows from that for 3, 5, 7 years in advance in the future, so you could see what the impact of the division would be. Sometimes taking and giving each side half of the assets just doesn't work out because cost basis isn't considered. Things growing tax deferred isn't considered. And to some extent, if you divide things 50-50, you can also run into the problem of what to do with the debt associated with those assets. In my own personal experience, my sister went through a divorce. She got the house. They had 2 mortgages. She was responsible for the first mortgage. Her ex-husband was responsible for the second mortgage. A few years down the line, when my sister sold the home, of course, they paid off both the first and the second mortgage. That's how collateralized loans work. But since there was no additional documentation or a promissory note from her ex-husband, she ended up paying off his debt and was really disserved by the divorce settlement.
Mm-hmm. Yeah.
And didn't talk to her little sister before she did this.
All right. So another pitfall that you bring up is the marital home and the options that there are for a couple going through a divorce. Could you break that down for us?
Sure. There's basically 3 things you can do with the marital home. You can sell it and split the proceeds or debt, depending on whether or not the home is underwater. You can own it together, but only have one person reside in the house. Although we are now seeing frequently that sometimes people are owning the home together, getting divorced, and still residing in the house together. That's a rather unique situation that we've seen evolving in the last couple of years, where they'll maintain the marital home as a site for the children to be raised. The parents have joint custody and move in and out of the marital home while they're the primary caregiver for the kids.
Yeah.
And the final option is to buy out the other party. You're going to keep the house, but the ex-spouse is entitled to a certain amount of equity, and you buy that person out.
Okay.
Because we're talking about a group of people that's 60 and older, the, staying together after divorce for the sake of, or living together after divorce for the sake of the children really doesn't apply to this particular age group. But what we are seeing happening is when it comes to the buyout of another person, you can use reverse mortgage as a financing option to either buy out one party in the divorce or to finance one party purchasing a house incident to divorce. And that's something that is a unique consideration for the gray divorce group.
Okay. And so I've run across folks in my peer group that are doing that cohabitating when they have young children, where they're moving in and out of the house, and I'm sure that that's uncomfortable, but there's no need to do that when you are in the gray divorce phase. So I could see these options also have some tax considerations that you're laying out. How would you suggest advisors take that into context when providing advice on this?
Well, one of the major tax consideration you should be aware of on keeping a house or the sale of a house after divorce is that there are special rules on the use period for a house. Your audience is probably well aware that you can, as an individual, shelter $250,000 of capital gains when you sell a house if you have lived in it for 2 of the last 5 years. And it doesn't even have to be consecutively, but 2 years. If a couple owns a home and gets divorced, but the title of the house is still in both parties' names, if the house is sold down the line, they're able to shelter $500,000 in capital gain, $250,000 per party, and the person who has moved out of the house gets to use the use period of the ex-spouse. So to put this quickly in an example that makes it easier to understand, if my husband and I were to divorce and I stayed in the house, if 3 years from now I sell the house, not only would I be able to shelter $250,000 of capital gains because I have lived in the house 2 of the last 5 years, but my husband would be able to shelter $250,000 of capital gains because he is able to claim my use period.
Okay, excellent. Now, let's move on to retirement plans. How do you suggest advisors approach the retirement plan issue in divorce?
Carefully, very carefully. There's a few issues with retirement plans. You need to know how to value the retirement plan. In a 401k or an IRA, that's an easy question. You look at how much is in the plan, you check if there's any loans against it. If not, bam, you have your value. But if you're looking at any kind of pension, you have to start looking at what portion of the pension was earned during the marriage, what the actual cash value of the pension is today, and then you'd also have to look into what the company that is going to be giving the pension allows you to do when you divide it due to divorce. One mistake that's frequently made is people will spend a lot of time drafting a qualified domestic relation order, quadro, to divide a pension plan with a company and not bother to talk to the company in advance. So they'll say that the wife is going to maintain a separate account with the custodian and will begin taking distributions when she reaches her retirement age. Well, if the company doesn't allow that, if that isn't part of what's in their summary plan description, you can't do that. So it's very important that before any plans are made to divide a pension plan, you contact the company first. Many large companies even have sample quadros. They'll lay out for you what you're allowed to do and what you're not allowed to do. This other thing advisors have to be aware of is when you are taking funds from a qualified plan, even if the person is not 59 and a half, you may take funds from a qualified plan incident to divorce without being subject to the 10% permanent premature withdrawal penalty. And the final thing you need to think about when you're talking about retirement plans and divorce, when you come into the over 50 group again, you need to be aware that some elections that they have made may be irrevocable. When my husband retired several years ago, he elected a joint and survivor annuity. He is getting less each month, so in the event he predeceases me, I will still get a benefit. If we were to divorce now, to be fair, there should be some offset to him because he has accepted a lower income to provide for me. And by the way, we're happily married, have been for 40 years. I just find it easier to use us as an example.
Sure.
But those are some of the basic ideas around retirement plans you should be aware of. And the final thing is you cannot divide an IRA account with a quadro. You can divide an IRA account. You need to talk to the custodian to see what they want. In most cases, it's just their distribution form and a copy of the divorce decree, but you don't use a quadro on anything other than an ERISA qualified plan.
Okay. Well, let's move on to insurance issues that come up when planning for a divorce.
Okay, there's a few, and they're very basic and I think somewhat obvious, but they can be overlooked. First of all, if either of the parties is considering getting long-term care insurance, it should be purchased prior to the divorce, simply because you get a lower rate if you are living with another person, married or not, than you do if you are living independently. So long-term care should be looked at prior to the divorce being finalized. Secondly, if you're going to have an award of either maintenance or child support, it's important that revenue stream be backed by an insurance policy for both life of the payor and disability of the payor. Just like you need that when you're a happy family unit. If one person is the primary breadwinner, you would make sure that person had life insurance and disability insurance. Once the family is divided due to a divorce, you still need to make sure the insurance is there to guarantee that revenue stream. And an important consideration unique to divorce is you need to make sure how the policy is owned. For example, if you are the wife receiving alimony and it is backed by a life insurance policy, you would want to be the owner of that life insurance policy so you would know if the beneficiary changed. That would be an important consideration.
Sure.
Or if your ex-spouse stopped paying for the policy and it was lapsed. Those are things you're only going to know if you are the owner of the policy. So it's important that you make sure insurance is titled correctly and owned correctly. The final thing is when you're talking about high net worth clients, they can have luxury items like boats and cars and art collections, that type of thing. You need to make sure that the specialized insurance they need for those items is still going to be affordable to the person who gets the item. Just like there are credit scores, there are insurance scores, and your credit score is part of that insurance score. But whatever you were paying for insurance on an item prior to the divorce is not necessarily what your insurance rate is going to be after the divorce. And there's nothing worse than setting it up so an individual gets a certain item in the divorce and then finding out post-divorce that they're unable to adequately insure it.
Okay. Excellent. And Carol Lee, finally, what should advisors consider post-divorce as it relates to providing advice?
Well, there's a few things, and some of them are very common to what you do in financial planning in general. You have to make sure once you come up with the plan of the division of assets that everybody follows through and does their parts. Make sure that life insurance policies are appropriately titled and have the appropriate beneficiary. If you're maintaining a 401k, an IRA, or a retirement plan, make sure you have the proper beneficiaries on those. Make sure that on any debt that comes out of the marriage, a credit card, a mortgage, whatever, that the debt is refinanced and put in just one party's name. You two can agree that the car loan is his responsibility and only his responsibility. But if the car was initially financed when you were married and both of your names were on the loan, if he defaults, it affects your credit.
Sure.
Finally, you need to make sure that any quadro that was drafted is given to the company involved and the administrator accepts it and announces that they will indeed do whatever the quadro has asked. And the last thing you need to be aware of is automatic revocation. 26 states now have rules in force that any beneficiary designation that was made prior to divorce is voided when the divorce is final. When I worked at Wells Fargo, we had an individual who had an IRA account. He listed the beneficiary of the IRA as my ex-wife, Susan. But due to the terms in the state we were residing in at the time, that beneficiary designation was considered voided by the divorce. And we actually had to go up to Wells Fargo counsel to say, obviously, that was not his intent. He even said ex-wife when he wrote her name. But it's something you need to be aware of that, if you intend to keep an ex as a beneficiary, make sure you sign new beneficiary documents after the divorce.
Okay, excellent. So, Carol Lee, how could listeners find out more about your organization, the designation, and tell us a little bit about the program?
Well, our program is currently a self-study program, but I'm pleased to announce that by the end of this calendar year, we will be online and have e-learning platforms with virtual classrooms. To find out about our program and our designation, you can visit our website, which is institutedfa.com. Institute, D as in divorce, F as in financial, A as in advisor.com. Currently, most people complete the designation in 3 to 4 months. Once you have completed the designation, we have a continuing education requirement of 15 hours of CE every 2 years and annual certification fees. In order to make it easy for our CDFAs and any other financial advisor to keep current on divorce-related issues, we have a free webinar on the third Tuesday of every month at 1 p.m. Eastern Time that qualifies not only for CDFA CE, but also CFP Board CE.
Excellent. Carolee, thanks so much for coming on the podcast.
Thank you, Jay.